Recording in progress.
Are we good to start?
Then Varun, just wait for some more time. People are still joining in.
Plus Life Mutual Funds Market Navigator Expert Series. Today we have with us our expert, Mr. Vinod Bhat, who is working in Aditya Birla Life Mutual Fund as a portfolio manager and head of equity strategies. That agenda for today's discussion is going to be on the fund which he manages, which is Aditya Birla Sun Life Asset Allocation Fund of Fund, and also we are going to discuss about the markets, be it on the equity, debt, as well as on the gold side. Before starting the discussion, I would like to share a perspective about the this platform of Market Navigator. What's the objective of this platform? So we started this platform around 2 years back in July 2022, wherein our endeavor is that from time to time we get in touch with our partners and share our perspective about the markets, about the macros, how they are shaping up, and we should be able to share our perspective about the portfolio structures and our strategies going ahead, so that our distribution partners are being able to take some informed decisions while committing their investment to our AMC. To give you a brief about Mr. Vinod Bhat, who is our expert speaker today. Mr. Bhat has got more than 20 years of experience into the corporate world, out of which last 15 years or so he has spent into the investment banking as well as there into the financial markets. He joined us in 2018, and prior to that he worked for the organizations like Credit Suisse and Ocean Park Partners LLP, which is based out in USA. Academically, he has done MBA in finance from Wharton School, which is from University of Peninsula in USA, and he has also done mechanical engineering from IIT Mumbai. Now, without taking much time, I would like to start the discussion while asking some on questions on the macro side, because in the last 6 months or so, what has happened post Russia and Ukraine war, there are a lot of macro developments which are happening, be it on the the GDP side. The inflation is moving up, the downward revision on the GDP is happening, the commodity prices are moving up. We have seen across the world some corrections also. including the Indian equity markets. That is also not been able to meet the expectation in terms of returns. So keeping in mind all the the factors which are prevailing at this point of time, it's very important to listen to our expert, how he is looking into the the macros which are shaping at this point of time and what lies for us going ahead. So over to you, Mr. Vinod.
Sure. Yeah, thanks, Barun. It's my pleasure to be here with you in today's session. And as you correctly mentioned, there are a lot of developments on the macro side, both globally and in India. And I'll try to cover that in brief, and it'll be helpful to show some data points and charts. So just give me a second, I'll share my screen. Yeah. So to start with, when we talk about macro, we talk about growth, we talk about commodity prices and inflation, we talk about interest rates and central bank policy actions, any geopolitical development. So let's try to look at these points, right? So starting with growth, as we know, the IMF recently downgraded the global growth projections, and all the prominent regions saw downgrades. So, for example, in the US, the growth got downgraded to about 2.9%, and that was because of reduced consumer spending, right? That was the main reason, as well as a tighter monetary policy. In China, there was a downgrade in growth because of the lockdowns due to COVID, and the property sector is also seen a downturn. Lastly, Europe is facing an energy crisis because of conflict with Russia, and their GDP growth has been downgraded to 1.2%, right? So the probability of a recession has also increased, especially in Europe and the US, although at this time, it is expected that the recession will still be mild and a severe recession is not expected. India, I should mention, is a standout in this regard. Although we also have seen some downgrades, but even now, our real GDP projection for this fiscal year is still at about 7.2%, which is much higher than the other regions. But what has also happened because of these growth downgrades is we have seen a downtrend in the commodity prices. So, for example, metals have come down almost 30 to 40%, whether it's aluminum, zinc, steel, and other metals. We have seen crude prices fall almost 25% from as high as $139 a barrel to now about $95 a barrel. So that's good news for India. And this kind of feeds into the inflation, right? So earlier inflation had reached almost a 40-year high, both in the US and in other regions, because of higher commodity prices, because of supply chain issues, because of higher wage growth and so on. So going forward, what we are expecting is that the commodity prices will start, they've already started coming down. Supply chain disruptions are starting to ease. However, we have seen in the US, for example, that the job growth and wage growth is still high, right? So while commodity prices will result in lower inflation, the higher wage growth will still contribute to higher inflation. So that's kind of a balance we need to see where things pan out, right? So later today, the US is expected to announce the inflation number for July. It's expected that it will come at 8.8% year over year compared to last month's 9.1%. So the thought is that most probably inflation has peaked and it should start, it should be lower than the last reading, but it will still be very high. 8.8% is still very high from an inflation standpoint. And that leads into the Fed and other central bank policy action. So we saw that in the last meeting, the Fed raised rates by 75 basis points. And now the expectation is that after the robust wage growth report, even in September, they will raise rates by another 75 basis points. And then we'll have to see what commentary they talk about, like whether it's hawkish than before or they'll be a little bit dovish, right? So as of this time, many of the Fed governors have again come out with hawkish rhetoric. So it's giving a sense that we will continue to see aggressive rate hikes by the Fed and other central banks. Now, what that has resulted in is also the dollar strengthening, right? So we have seen the dollar index had gone as high as 108. It has now come down to about 106.6. And typically when the dollar strengthens, it's not good news for emerging markets, including India, right? So we always need to keep one eye on the dollar. And currently it's still on an uptrend. Now, this is as far as the global macro is concerned. So essentially, there are concerns about slowing growth. There are concerns about high inflation. And there are concerns about aggressive policy rate hikes by the Fed and other central banks. But if we come to India, the story is quite different. Like I said, we are kind of better placed in terms of economic growth. So all the high frequency indicators have come back up above the pre-COVID levels. So whether it's GST collections, which we know are at close to all-time highs, whether it's electronic toll collections, whether it's the PMI numbers, electricity consumption, fuel consumption, all of these indicators are above their pre-COVID levels. And going forward, over the next 3 to 5 years, we believe that all the three drivers of the economy, whether it's consumption, investment, and exports, all of them will fire in India, leading to reasonably strong GDP growth. So on the consumption side, we are seeing that discretionary consumption is on the increase. People have started moving out more after the COVID pandemic. There are several structural drivers in place, especially the young demographic, increasing proportion of women in the working population, the changing tastes of consumers where they prefer branded products and so on, and hence that will lead to an increase in discretionary consumption. On the investment side, we have seen the government's focus on infrastructure remains in every budget. They increase the budget for infrastructure development. They have come out with a number of reforms, especially the PLI schemes, which will aid in investment. And lastly, on the export side, last year itself, exports from India had improved. Now, if the global economy slows down, there will be some downtrend in exports from India also. But we expect if we take a 3-year horizon, then exports will be strong. And here, many of the MNCs, like we know, are now following the China plus one model, where they want one more manufacturing base in addition to China, whether it's in Taiwan, India, Bangladesh, or any other Southeast Asian nation. And this is happening especially in sectors like textiles, specialty chemicals, and other manufacturing segments. So overall, we expect all these three drivers to fire. And hence, if you look at India's real GDP growth, like I mentioned, for this fiscal year FY23, we are expecting a 7.1% year-over-year GDP growth, compared to 1.2% in Europe, or 2.2% in US, or maybe 3.5-4% in China. So it stands out compared to the other regions. And lastly, a couple of months back, there were concerns on the macro stability side, especially because of the increasing crude oil prices and the higher commodity prices. But now, as I said, commodity prices have come down, food prices have come down, and inflation in India seems to be much more manageable than in other regions. However, we saw that in the last policy meeting, the RBI raised rates by 50 basis points. So our policy rate currently is at 5.4%. We believe that the terminal rate in India may be about 6%, because if the Fed and other central banks are raising rates, and even the RBI can't fall behind, they have to protect the rupee, hence they are also raising rates. But overall, from a macro stability point, if crude oil prices remain between $90 to $100 a barrel, then our fiscal deficit or a current account deficit is fairly manageable. Rupees also can be managed. We have high forex reserves of almost $570 billion. So macro stability is also not an issue. So overall, to summarize a macro view on the global side, there are concerns about slowing growth, high inflation, aggressive central policy action. Whereas in India, we are seeing that we are in the recovery phase of the economy. Most of the high frequency indicators are above the pre-COVID levels. We expect consumption, investment, and exports to fire over the next 3 years, and Indian economy to do better than other economies. And the macro stability is also not much of a question mark right now.
So the message which I have got from you is that though the global GDP numbers are coming down, the major blocks of the global economy like US, Europe, and the China are slowing down. And though there is a concern on the inflation, but keep setting aside all those concerns, India seems to be at the right better place, and our macro indicators are pointing towards that we are at a much better shape as compared to the other economies of the world.
Right.
So Mr. Bhat, I would like to know, ultimately, stock market is a slave of earning.
Yes.
So whatever your macro developments which are happening, be it in the upward movement to the commodity prices, and a lot of others increasing to the interest rates. Maybe by the end of this financial year, we are going to see a repo rate which is near to 6%, and globally also the interest rates are moving up. So given that backdrop, how you are looking into the earnings to shape up, both at the domestic level as well as into the international market?
Yes, so that's a very interesting question, Barun, because what has happened is, given all the macro concerns, everybody was expecting some downgrades to earnings, both globally and in India. but that really hasn't happened so far. So if you see in the US, at the start of the year, the earnings growth for the S&P 500 for this calendar year was expected to be 8% year over year. And to everybody's surprise, it actually got upgraded to 10%, right? And the main reason for that was the energy sector, right? So because oil prices went up, all the energy companies started doing well, metals prices went up, so all the commodity producers saw all-time high profits. And although there was some downgrades to earnings in sectors like, consumer discretionary, that got offset by upgrades to these other sectors, right? So globally, to everybody's surprise, we have seen either earnings remaining stable or seeing an upgrade, right? But just over the past couple of weeks, like given that the June quarter earnings reports have come out, we have started seeing some warnings of future profits from companies, right, for the second half of the year. So like yesterday, for example, Micron Technologies, and day before, NVIDIA, which are two leading semiconductor companies, they warned of slowing demand for semiconductors because of slowing growth, right? Like I mentioned, in the US, consumer spending has started coming down, consumer savings have started coming down. So slowly, we are starting to see some concerns on future profits, and we are expecting some downgrades to earnings to happen globally. Now, again, here I'd like to show you some charts on India also, because what we are seeing in India is something slightly different. Okay, so in India also, we were expecting that we will see earnings downgrades. And so far, again, that has not happened, right? So if you see, like I mentioned, if our real GDP growth is expected to be 7.1% this fiscal year and 6.5%, let's say, our next fiscal year, then the corporate profit should also do well. So there we track a ratio called the corporate profit to GDP. Okay. And what we can see clearly is that over the past decade or more, from 2008 to 2020, these are fiscal years, there was a consistent downtrend in the corporate profit to GDP ratio from about 5% to about 2%, right? But over the past couple of years, we have seen this corporate profit to GDP ratio on an uptrend. So there's been a turnaround. And we are slightly above the long-term average right now. And the main reason for this is that some of the sectors like the PSU banks and the telecom sector, which used to see big losses, they have turned around. Like I mentioned, the commodities sector, like metals, oil and gas, they have seen all-time profits. And hence the overall corporate profits have increased. Now, going forward, our projection is that if you look at the Nifty earnings growth, if you look at the next 3 years, we expect around a 15% earnings CAGR for the Nifty. Okay. And that's very good, because if you look at, for example, the average for the past 5-6 years, it was actually less than 5%. Like every year we used to expect 15 plus, 15 to 20% earnings growth, and we used to end up at single digit earnings growth, right? Same thing, if you see the average for the last 10 years, it's around 11%. But over the next 3 years, like I mentioned, if in India, consumption does well, investments does well, exports do well, if India's real GDP growth is around 6.5 to 7%, then if you add about 5.5-6% inflation to that, then the nominal GDP growth will be about 12 to 13%. And historically, we have seen if nominal GDP growth is 12 to 13%, then earnings growth typically is around 15%, and that's what we are expecting for the next 3 years, right? So that's not to say that in the short term there are no concerns. So even in India, we may see some earnings downgrades. Like if there is a growth slowdown globally, India is not going to escape, right? Some of our export-oriented sectors may see some downgrades, for example. But we still expect domestic demand to hold up, and that should offset, right? So overall, at a Nifty level, we expect around a 15% earnings CAGR. If we exclude, for example, the commodities, we may see around a 10 to 12% earnings for the next fiscal year. So that's the view on the earnings side.
So given the backdrop of the earnings and the way macros have shaped up, now let's talk about the valuations. So now, in the last, had I asked this question around a month back to you, the answer would have been, lot much easier. But in the last 1 month, we have seen some uptick into the markets across the globe.
Yes.
If you set aside certain markets like Russia, China, and the Hong Kong, other than that, most of the markets has moved up. Keeping in mind, the current valuation which is there, if you can help us to understand how the valuation front is there in terms of Indian as well as the global markets, how you are looking into the valuations per se at this point of time.
Right. And, valuations are best explained with numbers. So let me go back to my charts. It will give you a better context for what I'm about to say. So let's start from the global side, right? So as you correctly mentioned, since the beginning of the year, we had seen a significant correction in global markets. Okay, so for example, in the US, Nasdaq had gone down almost like more than 35%, and S&P 500 was down almost 25%, right? And over the past 2-3 weeks, there has been a rally in markets. But overall, if you see, for example, this is showing a 1-year forward PE ratio for different headline indices in different countries. So if you see the US, which is the second last row, this is as of July end, 16.5. Currently, it's about 17.5 for the S&P 500. And it will be about 7-8% premium to the long-term average. Okay, in the US, the valuation is about a 7-8% premium to the long-term average. If you see in the Eurozone, for example, it's still at a discount. So like I mentioned, in Europe, there is a higher risk of a recession because of the energy crisis, especially given that they'll be entering into the winters and Russia may reduce the supply of gas and so on. So European markets have seen a bigger correction, and Europe is trading at a 8 to 10% discount to the long-term average. If you see emerging markets, there the valuation is close to the long-term average, right? So overall, if you look at the world, we are trading at about 15 times forward on a PE basis, which is, again, we can say close to the long-term average. So globally, to summarize, we can say that the valuations are reasonable. They are trading close to the long-term average, right? Now, coming to India specifically, if you look at the Nifty and different ratios, if you look at the price to book for the Nifty, after the recent rally, we are at a 3.1 multiple on the price to book. The 10-year average is about 2.9. So you can say it's about a 8% premium to the long-term average. Okay. If you look at other metrics, for example, the 1-year forward PE, so there we are at about a 19.5 times. The long-term average is about 18 times. So again, we are at around let's say 8 to 10% premium. And same thing, if you look at the yield gap ratio, which compares the earnings yield to the 10-year GSEC yield. So again, it's like close to the long-term average. So overall, India seems to be at a 8 to 10% premium to the long-term average, whereas the world is, just close to the long-term average. So, given that, economic growth in India, visibility is high, earnings growth, visibility high, Indian markets haven't really corrected as much as, for example, in the US or in Europe or even China, right? And that's the reason why the valuations are still slightly above the long-term average. And hence, to summarize, I can say that valuations are, we can say they are reasonable. They're not really really attractive at this point as far as India is concerned.
And there, comes my next question, which is related to the liquidity. Last 1 year or so, the FIs were pulling out from the Indian market. They withdrew approximately $32-33 billion kind of money from the Indian domestic markets. During that period of time, the domestic institutional investor came into the rescue, well supported by the mutual fund industry. They infused, somewhere close to $35-36 billion kind of money into the Indian, equity markets. So, given the current scenario which we have, how you are looking into the liquidity situation going forward. Having said that, we have seen that in the last couple of weeks, the FIS has started coming back to the Indian market. So, in your view, how the liquidity is going to plan up, in the next couple of months, couple of quarters, keeping in mind the strong, footnote which we have in terms of our macros. And of course, the valuations is also one of the consideration. So, how you are looking into the liquidity situation going forward especially for the Indian market?
Correct. So, see, if we go back to years like in 2020, 2021, when interest rates globally were close to zero, and there was a lot of liquidity introduced by central banks, FIIs were investing all across emerging markets, whether it was in India, Taiwan, Thailand, Indonesia, Malaysia, Brazil, right? Everywhere, right? And that led to a rally in all the emerging markets. Over the past, you can say 9 months since October, once there was visibility that interest rates would be increased and central banks would start reducing their balance sheet, FIs became very selective, right? So when commodity prices went up, when crude prices went up, we saw big outflows from commodity consuming countries like India, for example, or Taiwan and Thailand. saw big outflows. India alone, like you mentioned, since October we saw almost $38 billion of outflows, right? And where did that money go? One, it went to the commodity producing countries, for example, to Brazil, right? Then it also, some of it went to China because China had seen almost a 45% correction, Chinese equity market. So valuations were attractive. So the money went to China, right? Now, current situation, if you see clearly, interest rates are increasing. All the central banks are reducing their balance sheets. So FIs are going to be very selective in terms of the markets that they invest. And over the past month, we have seen commodity prices have declined, right? So that is negative for the commodity producing countries, but it's positive for the commodity consuming countries like India, right? And hence we have seen, for example, in July, we saw FII inflows of about $650 million. In August, just in the past week, India has got almost $1.5 billion of inflows, right? So it's no surprise if crude prices have declined 25%, right? Suddenly India becomes attractive, right? Now, the only concern the FIIs have is the valuations. Like I mentioned, Indian equity markets haven't really corrected much compared to other markets. If you compare our PE multiple to the other emerging markets PE multiples, we are trading at almost a 60 to 65% premium, right? And that's happened because even though FIIs have exited, the domestic investors inflow has been very strong, right? So the entire outflow from the FIIs was offset by the domestic investors, and that has held up our equity markets, right? So in spite of that, now we have started seeing FII flows coming back. And like I said, compared to other regions in the world, India gives the best visibility to economic growth, the best visibility to earnings growth, right? And hence, we expect that we will continue to see FII flows coming back over the course of the second half and going forward. And in any case, we are seeing that domestic investors have become much more mature. Even if there is a 5 to 10% correction in the markets, we see the inflows going up. We expect that to continue. And hence, if FII flows come back, if domestic flows also remain strong, we expect that to be positive as far as the equity markets are concerned.
So, given the background that going forward, FIIs flows and the overall liquidity into the system, into the Indian domestic market are going to be much more easier. Though on a valuation basis, we are slightly 10% trading at 10% premium to the overall long-term average.
Yeah.
Also, given the backdrop that our overall macros are much more stronger as compared to the overall global economy, how you look into the equity markets in India going ahead? So, if somebody is asking you, what should I see into the equity markets for the next 1 to 3 years? What should be your message?
Sure. So here again, it's good to look at the global context first, and I'd like to share some charts in that regard. So just give me a second. Yeah, so let's look at the US first, right? Because it's the most tracked market. So if you see the S&P 500, what has happened is over the past couple of weeks, S&P 500 has gone up by about 13%, but it's still down about 14% from its peak. Okay. If you look at the NASDAQ, which is more tech heavy, again, over the past couple of weeks, it has gone up almost 20%, but it is still down 20% from its peak. Okay. And if you look at Nifty in India, for example, for the past few weeks, we are up 15%, but we are still down about 5% from the peak, right? So clearly, we didn't correct as much as other markets, and we have kind of recovered also in line with other markets, right? And given what we discussed, right, one is that the valuations are above the long-term average. They are premium to other markets. But like I mentioned, globally, there are significant corrections about slowing growth, about high inflation, and about aggressive policy rate hikes by the central banks. Whereas in India, we are much more positive on economic growth, much more positive on earnings growth. We believe the macro stability is quite high. Inflation is quite manageable. The only reason RBI may increase rates is to keep pace with other central banks and protect the rupee, right? So considering this overall macro backdrop, we believe that in the short term, the market could remain range bound. So, we have been seeing over the past few months that our range for the Nifty is between 14,500 to 17,500. Currently, we are at the top end of that range, right? given the concerns like in the markets, and especially let's see what the inflation reading comes out today in the US and what the commentary we will get from the Fed going forward. There's a possibility, and of course, what happens in Europe, considering the energy crisis and the conflict with Russia. So those are some concerns that we are monitoring. And given the global macro backdrop, which is a dominant driver for equity markets currently, there could be some intermittent corrections. Okay, so overall, we believe that the market will remain range bound. That's the short term, though. If we take a step back and if we take a 3-year view, for example, we remain very constructive on Indian equities. Like I said, we expect the Nifty earnings CAGR to be about 13 to 15% for the next 3 years. If the earnings CAGR is 13 to 15%, and if the valuation multiples hold up, or even if they contract a little bit, hence we think that the market returns can be just below the earnings CAGR, right? So that can be about 12 to 13% CAGR returns from the Nifty over the next 3 years. And if Indian economy does well, then we can expect mid caps and small caps to do better than the large caps. So that's the view on the overall market. And if we come to themes, there are 4 themes we are positive on. First is the discretionary consumption. Okay, so that includes the low ticket consumer durables, that includes the auto sector, that includes retail. Like I said, given the structural drivers such as the young demographic, increasing proportion of women in the workforce, increasing preference for brands, we expect discretionary consumption to increase. The second is banking and financial services. If the economy does well, then banks and NBFCs will do well. Like credit is like the lifeblood of the economy, so we expect that sector to do well. We expect real estate and associated sectors like cement, paints, consumer electricals to do well. And lastly, we expect the industrials and capital goods sector to also do well. Lastly, I'd also mention the digital or the tech theme because it's a secular theme for the next decade. So overall, our recommendation remains that investors should continue the SIPs with a 3-year horizon, and especially if there is any correction, they can add using lump sums and increase their equity exposure.
So can I share this message with the audience that this is a time to be overweight on the domestic equity rather than having an overweight on the it's a time for underweight on the international equities. Can I interpret that?
Yes, so definitely from a diversification point of view, we should have some exposure to international equities, but you have correctly summarized it that we are much more positive on India than on other global markets. We think India will deliver better earnings growth and returns in other markets, and hence the bulk of the equity exposure should be to domestic equities.
Okay, fine. So let's now come to the fixed income investments. When we look into the fixed income basket, which if you look at the term curve, which side of the term curve seems to be attractive at this point of time? What should be the optimal debt strategy for the investors, keeping in mind that the interest rates are moving up, the inflation is still sticky? What is your recommendation for the fixed income investor at this point of time?
Yeah, so it's best to look at the yield curve to get an idea of what's going on, right? So this is the sovereign yield curve for India, and as you can see, it's quite steep, right? So like I said, inflation in India seems to be manageable, but given that the Fed and other central banks are expected to remain aggressive in terms of rate hikes, RBI will have to follow that path too, right? So currently, our repo rate is about 5.4%. Our expectation for the terminal repo rate in India is about 6%. So we can expect a few additional rate hikes going forward, right? Yeah. And hence, the view is that at this point of time, the ultra short term, and the low duration funds are still the best places to be in, okay, as far as fixed income is concerned. However, given that the yield curve remains to be steep, if some investors are okay with the higher volatility, if they can keep a 3-year plus horizon, then they can look at slightly longer duration also, and they can look at our passive strategies in our debt index funds to take that exposure. But the bulk of the exposure should remain to the short term and low duration products.
Okay. So Now, what's your view on the gold? In the last 4 years, I was just looking into the data. Since 2018, the gold has done phenomenally well. Till 2020, the returns were absolutely, great. But in the last 2 years or so, on an international platform, what we have witnessed is the gold is in range of around $1,800 to $2,000 per ounce. But though Indian investors has been able to generate around 8 to 9% in the last 1 year because of the currency play. But on an overall basis, as gold as an asset class, how you look into this asset class at this point of time? What lies for us, gold as an investment class, in the next couple of months and quarters?
Yes. So if you look at the trajectory of gold prices, we saw that gold gave really good returns during the COVID crisis, almost 30% in 2020, right? But prices have declined about 13%, let's say, over the past 5-6 months. In the last 2 weeks, they have risen about 5%, given increasing concerns on inflation and, of course, the continuing geopolitical conflict. Now, if you look at the factors that drive gold, so one is, gold, is considered to be a hedge, whether it's against inflation, whether it's against geopolitical uncertainty, whether it's against recession, right? And currently, all these three risks are very high, right? We still don't know what can happen in the Russia-Ukraine conflict, whether there'll be a gas crisis in Europe. We'll only know that over the next 4 to 5 months. Now the China-Taiwan conflict has also come into the picture. So geopolitical uncertainty remains high. Like I said, there are some growth slowdown fears and fears of recession, both in Europe and in US. And lastly, there are concerns on inflation remaining high also, right? So all these factors are positive for gold. However, then what led to the correction in gold prices? The reason was the aggressive rate hikes, which led to the stronger dollar. Both of these are negative for gold, right? So if the real rates in the US rise and if the dollar strengthens, then it's negative for gold. And that was a reason why the gold prices corrected almost 13 to 15% now, right? So if we take a view for the next, let's say, 6 to 9 months, then we can expect all the three risks, whether it's the geopolitical uncertainty, whether it's the inflation or the recession, they will remain high for some time, but hopefully they will play out. But gold hopefully provides a hedge against these risks, right? And if we see inflation moderating, if we see the rate hikes moderating by the end of the year, then we are expecting the dollar also to start depreciating, right? So that will be positive for gold. And hence, from a portfolio allocation point of view, we would recommend having some exposure to gold because it's negatively correlated to equities and to fixed income. And from that point of view, it's important. It's an important component of the overall portfolio allocation.
To summarize the discussion which we have so far, so this is a time to be overweight on the Indian equity as compared to the international equity. Second is when it comes to the fixed income baskets, this is a time to be overweight on the short end of the curve. The funds like Aditya Birla savings fund, money manager fund, low duration funds like, and at the same time, if the investors investment horizon can match with the target maturity funds, perhaps these are the two segments wherein the margin of safety is there. And perhaps if the investor can bear the volatility for the next couple of months, even the short term and the corporate bond funds also make sense into the investor's portfolio.
Correct.
You shared about your perspective about the gold as well. Gold, keeping in mind the macro dynamics playing out, gold demands a allocation at this point of time into the client's portfolio. So, Mr. Bhat, what I have seen in the last 10 years or so, the market cycles has become very short. Sorry, I'm audible?
Yes, please go ahead.
Yeah, so what I've seen that in the last 10 years or so, the market cycle has become very short. From a portfolio manager point of view, and as well as from the investors' point of view, having an overweight and actively managing the overweight and the underweight positions into the various asset classes like domestic equity, international equity, gold, as well as into the fixed income has become very, very important. And that's where our Aditya Birla Sun Life asset allocation funds comes into the picture, because this is a fund which is exactly doing the same, keeping in mind the overall macros, the valuations, and the liquidity scenarios, and the various factors which are being considered for the investment decisions. There is a dedicated fund manager who studies all those factors and decides upon the overweight and the underweight positions into these four asset classes. Now, I would request you to please, share some light, share the process while you manage this fund for RENC.
Sure. So, look, if you talk about different asset classes that we covered, it's always good to start from a longer term horizon, right? So if you look at, for example, different asset classes like gold, fixed income, property, equities, over 5, 10, and 20-year horizons, let's compare the returns, right? So if you see, for example, property, although most Indians love investing in real estate, it hasn't really given great returns over the past 5 years or even 10 years, right? It's less than 5%, and only if you look at a 10, 20-year horizon, maybe it's given a 7-8% CAGR return, right? If you look at fixed income, it's given about a 7 to 8% kind of a return. If you look at gold, given the uncertainty over the past 5 years, it has given about a 12% CAGR return, but the returns of the last decade have been less than 5%. And over the last 20 years, it's about 11%. Compared to these asset classes, equities has given the best return. So whether it's 5 years or 10 years, the CAGR is about 12 to 13%. For 20 years, it's more than 15%, right? And hence, we believe that although each of these asset classes warrants a place in an investor's portfolio, always investors and advisors should keep in mind this long-term return profile of the asset classes, because things remain fairly stable, and this is what you can expect from different asset classes over a 5, 10, 20-year time frame. Now, that said, if you go into the next level of detail and look at year-by-year returns, like you correctly mentioned, things are very volatile, and it's impossible to predict which asset class will give good returns in any given year. So in CY17, it was domestic equity. CY18, it was fixed income and gold. CY19, it was international equity. CY20, during COVID crisis, it was gold. 21, it was equity. This year, equity is not doing that great, right? So while it's tough to predict which asset class will do well, you don't need to do that. We should just have exposure to these different asset classes in the portfolio. And in that case, then because these asset classes are negatively correlated, the overall volatility of the portfolio becomes much lower, and we can expect a better risk-adjusted return, right? So that is the thought process behind the ABSL Asset Allocator Fund of Fund. Here we give exposure to 4 asset classes: domestic equity, international equity, fixed income, and gold, right? So here each asset class plays a different role. It's like putting together a cricket team or a football team. If you take that example, gold is like the goalkeeper in a football team. It gives a hedge against inflation, recession, geopolitical risk, right? The fixed income is like the defenders. It provides a stability to the portfolio. International equity, it helps in diversification. And lastly, domestic equity is like the forward which scores the goal. It gives you exposure to the higher growth, like I mentioned. And as far as our asset allocator fund is concerned, we have complete flexibility to invest across these asset classes, but we also have set up some internal bands so that we have some discipline when it comes to investment. So on the domestic equity, on the equity side, we can range between 20 to 80%, of which 0 to 15% can be to international equity. Fixed income allocation can be between 15 to 75%, and gold can be between 5 to 15%, right? So that's a broad construct. Now, for each of these asset classes, there is a streamlined framework in place. On the domestic equity part, for example, the core of the investment will go to the large cap and the diversified funds like the flexi cap, large and mid cap, and the multi cap fund. The satellite investment will be to mid and small cap funds or sectoral thematic funds. On the fixed income side, the core investment will be to the funds which invest in high quality papers, and we can have some exposure to low and medium duration. On the satellite side, it could be some tactical allocations, either to longer duration or to credit. On the international equity side, we invest either in the index ETFs or in our international fund. And on the gold side, we invest in the gold ETF, right? So this is broadly the investment framework. Now, when it comes to the process itself, that's where we differentiate ourselves from some of the other asset allocation funds in the industry. We follow a process which combines both quantitative inputs as well as qualitative inputs. On the quantitative input side, we have a model that we run. That model looks at various parameters. For example, price to earnings ratio, the price to book ratio, yield gap ratio, as well as momentum and volatility parameters. And it gives us a signal in terms of what should be the recommended allocation to domestic equity, international equity, fixed income, and gold. Okay. And this model we have backtested over the past 2 decades, and it has given quite very good results in the backtest. So if you see these charts, the pink bars are the recommended equity allocation, the gray bars are the fixed income allocation, and the yellow bars are the gold allocation. And whenever there was a correction in the market, so for example, in March, April 2020, the model suggested increasing the equity allocation to 80% or more. Similarly, when there was a correction in either 2008, 9 or 11, 2013 and so on, the model suggested increasing the equity allocation. So that's how the model works. If there is a correction in the market, it recommends increasing the equity allocation. If there is a rally in the markets and market seems overvalued, it recommends us to decrease the equity allocation. And the reason for having this model is to overcome our human bias, right? So for example, in March, April 2020, at the peak of the COVID crisis, when our markets corrected 40-45%, it would require a lot of courage to increase our equity allocation. But our model recommended increase equity allocation to 80%, and we did that, right? And that's how the model helps. And if you look at the backtesting results, we can see that the return is higher than either the BSE 100 index or even a static model, and the drawdown is also much lower. So overall, the risk-adjusted returns are higher in the backtest of the model. But we don't just stop with the model. We also take qualitative inputs from our investment team, both from the analyst team as well as fund manager team, and especially also from our CIO, head of fixed income, and our economist. I get all these inputs, and based on which we finally decide the overall asset allocation and the funds to select. And even for the fund selection, we have another model which looks at all the funds in the industry in each category, whether it's large caps, flexi cap, mid cap, small cap, and so on. We look at the historical risk-adjusted returns for the past 3, 5, 7 years. And in each category, we rank the fund so that we know where each fund stands, what is the track record, is it consistent or not. And we also look at the fund manager's style. Is it growth? Is it value? Is it quality? Is it GARP? We make sure there is no concentration to any particular sector or factor or risk and so on. And combining both these qualitative and quantitative factors is how we put together the portfolio for this fund of fund.
Okay. What is the current positioning which we have in terms of asset allocation in the fund?
Yeah. So based on both the quantitative inputs from the model as well as, like I mentioned, the inputs from the fund managers and analysts, this is our current portfolio. So as you can see, the total equity allocation is about 50%, of which domestic equity is about 48%, and 2% is to international equity. About 8.5% exposure is to gold for all the reasons I had enumerated earlier, and about 40% plus is to fixed income and cash. Right now, if you look at within the asset class allocations, if you look within equity, the core, for example, is a large cap and diversified fund. So the large cap, which is our frontline equity and focused equity fund, it's about 25% of the equity allocation. The diversified funds, which is our flexi cap, equity advantage, and MNC funds, it's about, you can say, 30%. Okay, so about 50% or 55% allocation is to the large cap and diversified, which is the core of the portfolio. We have about 12.5-13% allocation to mid and small cap funds, and about 22.5% allocation to the sectoral thematic funds, which is banking and financial services, Gen Next, which is a consumption fund, and the Digital India fund. So that is in line with the themes that we are positive on. So this is on the equity side, and also, of course, we have some exposure to our international equity fund, like I mentioned, so that we keep some international allocation in the portfolio. On the fixed income side, like we discussed, the exposure is to our low duration and short-term funds mainly, and some exposure to our dynamic bond fund, and we have some exposure to the gold ETF. So the whole idea is that the portfolio of this asset allocator fund of fund crystallizes our fund house strategy. So whatever I told you before this, it wasn't just knowledge sharing. It was actually what we have implemented in our fund of fund portfolio. So whether it's advisors or investors, they can just look at our fund of fund portfolio, and it tells us what our strategy is, what our outlook is, right? So they don't need to. So advisors don't need to time markets. They can just invest in this one fund of fund. They get exposure to all the underlying funds, and they don't need to worry about the changing market dynamics. So this is a one-stop shop for the asset allocation, fund selection, as well as the periodic rebalancing. Now, in terms of why we have selected some of these funds, let me just quickly spend a few minutes on that. The Frontline Equity Fund, as you know, is a flagship fund managed by Mahesh Patil, who's the CIO. It has a stellar track record over the past 2 decades, giving almost a 20% CAGR. And in 14 out of the last 17 years, it has been above the median, like in the first or second quartiles. FlexiCap Fund also has a stellar track record. Over the last 24 years, it has given a 22% CAGR. And also it has been in the first or second quartile most of the time. Equity Advantage Fund, it has a, whereas, for example, Frontline Equity has a GARP philosophy, FlexiCap has a slightly value tilt, Equity Advantage Fund has a growth tilt, right? So if the Indian economy does well, this fund benefits. And hence, that is why we have this fund in the portfolio. On the mid and small cap side, the mid cap fund, it has a good balanced exposure both to consumer oriented companies as well as to the cyclical companies, and hence it finds a place in the portfolio. Lastly, on the sectoral thematic side, GenNext, like I said, is a consumption oriented fund. It has a really good track record over the past 2 decades, and hence we have taken that fund. And lastly, Banking and Financial Services Fund, because we are very positive on this theme and it has a good track record, right? So if you see, it's a mix of growth, value, quality, as well as GARP oriented funds. We have mid and small cap exposure also, and we have sectoral thematic exposure also. So that's how we have constructed the portfolio.
Mr. Bhatt, if you please throw some light on the the performance part, how the fund has been able to performed in the last couple of years or so, and what should be the investor expectation while putting their money into that kind of a fund?
Right.
So first, what we have delivered and what should be the expectations, basically.
Right. Yes. So this is the objective in this asset allocation fund is there are 2 objectives. So one, of course, is to focus on returns, but second objective also is to lower the risk or the volatility of the
portfolio. Right.
So the overall objective is to deliver a stable risk-adjusted return. So instead of, example, plus 20-25% in 1 year, negative 15% in another year,
right?
Don't want to deliver that kind of performance. What we want to deliver is fixed income or FD plus 3 to 4% return with very low volatility, right? So our target is to deliver, let's say, double-digit returns with low volatility. And hence, if you look at the track record, like if you look at the 3-year return of the fund, the 3-year CAGR, it's 12% for the benchmark, but the fund has delivered about 15% CAGR, okay, which is higher than our objective. But that shows good consistency, and we are in the first quartile in the 3-year time frame. If you look at the shorter term horizon, which is a 1 year, things can be much more volatile. As we have seen, conditions have been changing very quickly. Like in the first half of the year, for example, we had exposure to gold in the portfolio. Gold didn't do well, right? We have some exposure to growth-oriented funds, to mid and small cap funds, which didn't do well in the first half, right? Now they are coming back. So that kind of impacted the slightly higher beta of some of the funds impacted the performance in the 1 year. But given that we also have low beta oriented funds like our focused equity fund and our MNC fund, that balance things out. And hence, if you look at the past 1 month or 3 month returns, that has shown good improvement, right? But if you look at, for example, the 5-year CAGR again, compared to the benchmark of 8.5, the fund has given a return of 9%. And if you look at the volatility, it will be much lower than either the any equity index or the benchmark. So the overall, the risk-adjusted return will be quite good as far as this fund is concerned. So I would only like to reiterate that the purpose of asset allocation is to deliver stable risk-adjusted returns. It's not to deliver the highest return with high volatility. So that is what investors and advisors should keep in mind.
Okay. So, to summarize, I think this is a one-stop solution which we can offer to the investors, to our distribution partner. They need not to worry about how the macros are shaping up, which asset class to be overweight, underweight, and on their behalf, there is a fund manager who's actively looking into all these parameters and trying to provide a optimal better risk-adjusted returns for the investors. Right. I think all those investors, who are skeptical about the overall, volatility into the markets, that fund suits them well. And in fact, even an ordinary investor also who has already had an allocation into the normal equity funds, international funds, and other funds, perhaps this fund also makes sense for them. Perhaps they can compare how well the various asset allocations has been changing from time to time, keeping in mind the macros being shaping up. Now let me go into the Q&A and see what kind of questions which are being
Sure.
asked to us. So there is Mr. Anand who is asking our response on the technology fund and basically our digital fund and the US technology status. So what's your view on the technology and the US technology status at this point of time?
Right. So, over the past 2 years, like 2020, 2021, like we saw, the entire sector saw a huge rally, right? Because interest rates were near zero. There was a lot of liquidity. And that benefits long duration assets like the tech sector, right? Now, since the beginning of the year, or even like November, December, given the expectation of rate hikes, given the expectation of central banks reducing liquidity in the system, we have seen a correction in the tech stocks, right? Especially, FANG stocks had corrected 30-40%. The fintech stocks corrected 60-70%. The non-profitable tech stocks globally corrected 80-90%, right? And even in India, we have seen, for example, the IT services companies getting impacted. One was because of concerns on the global growth slowdown, and second, of course, because of the increase in interest rates. We saw the valuations or the prices of many of the tech IPOs that happened. They also corrected quite significantly. Over the past month, we have seen some recovery in prices of the tech stocks, right? So the expectation was that inflation seems to have moderated. Central banks may not be as aggressive in the rate hikes, right? We may not see a severe recession in the world economy and so on. But again, there is some uncertainty on that front. So like I said, today is an important day. The US will be releasing the inflation number for July. Then going forward, we will know what the Fed view on that will be, right? We will get more detail on how severe of a growth slowdown we might see in the US and Europe, which will impact demand for the IT service companies as well as the broader tech sector, right? So there is some uncertainty still as far as the tech and digital sector is concerned, both on the demand front as well as the interest rate front, right? And although we are positive on this theme, the whole digital tech theme is a secular theme for the next 10 years. We are very positive on that theme. But if you take a shorter term view, let's say a 1 year, 2 year view, we are more positive, for example, on the banking and financial services or the consumer discretionary themes as compared to the digital or tech theme.
Okay, so given a choice between the domestic technology and the US technology, which will be your favorite?
So I would have exposure to both. So like I said, there is no point saying this or that. In the digital tech theme, I would have exposure both to our IT services companies, some of our domestic digital companies, and of course, then I would also like to have exposure to the leading tech companies.
So we have the funds on the both sides. We have the Nasdaq 100 fund as well as we have the Digital India fund. So
Right.
Mr. Anand can take an exposure in both the funds.
Correct.
So, and given what is the style of investment which favors at this point of time, value or growth?
So see, globally, if you see, given the concerns, the value style right now is doing better than growth, right? If, for example, 6 months down the line, the macro backdrop seems to be that inflation has kind of moderated and we are over with the rate hikes, then again, we'll see growth coming back. But that's on the global side. In India, like I said, the situation is very different. We will be in the expansion phase of the economy over the next 3 to 5 years. Earnings growth will be very good. And we expect growth to continue doing well as far as India is concerned. And hence, that's why if you see the themes we are positive on, those are all the domestic consumption focused themes, whether it's banking, financial services, whether it's consumer discretionary, whether it's real estate and associate sectors, whether it's industrials, infra, digital tech themes. These are all growth oriented themes, and I would suggest, like I said, the bulk of your equity exposure should be to domestic equity, and in that growth should be the bulk of the exposure.
So whether the asset fund of ours is investing into the technology fund at this point of time, or has it invested in the recent past or so?
Sorry, which fund?
Our asset allocation fund has taken exposure into the Digital India Fund or the Nasdaq in the recent past, or are we, or I can say, maybe in the future?
So we had a much higher allocation. So during, I should mention the sector rotation we did over the past 2.5 years, like in the March-April 2020 timeframe, when during the first COVID wave, when it happened, the markets corrected, we selected our pharma healthcare fund and the Gen Next fund for the asset allocator fund of fund portfolio, because those were defensive oriented themes and they did well. Then in September, October 2020, when we were coming out of the first COVID wave, we shifted to our Digital India Fund and a Banking Financial Services Fund. So that's the time when we invested in the Digital India Fund. We took a good exposure to that fund because we realized that digital theme will do well, right? Then this year, we have reduced the exposure to the Digital India Fund and increased exposure to our Gen Next Fund and the Banking Financial Services Fund. And like I said, let's say over the next 3-4 months, if the picture changes, we think inflation has gone down, we are over with rate hikes, then we can think of again increasing the exposure to the Digital India Fund.
Okay. So I think the most of the questions which is being asked are repetitive in nature. So there is another question. If you please throw some light on the expense part of asset allocator fund. So there is a question on the same. So how we when we make the asset allocation, under which plan we put the money, and what is the overall expense which is there in the fund asset allocation.
Yeah, so let me just share my screen. In terms of, although Barun mentioned the key advantages of the asset allocator fund, I'll just quickly reiterate. So the biggest is the significant cost saving. Okay, so one aspect is that, see, when advisors rebalance portfolios for their investors, there are tax implications, either short-term or long-term capital gains. Whereas when the fund of fund rebalances the portfolio, there are no tax implications for the investor because the fund of fund itself is a mutual fund, right? So as long as the investor doesn't redeem the units of the fund of fund, there are no tax implications. The other advantage is the fund of fund invests in underlying direct plans of the mutual funds or in ETFs. Okay, so that also reduces the underlying expense. And if you see, the way it works is the weighted average expense ratio of the underlying funds is around 67 bips. And as per the SEBI mandate, there is a cap on the total expense ratio of the fund of funds. So currently, for the regular plan, the expense ratio is about 2% at the fund of fund level. And that includes both the expense of the underlying funds as well as the expense of the fund of fund itself. So that's how it works. The other advantage I just quickly mention, one, a dedicated fund manager manages the fund of fund. So I am doing this, the research, the monitoring of the portfolio, the rebalancing. The overall volatility is lower, like I mentioned, because of the negative correlation between various asset classes. It's highly convenient because advisors need to monitor only one statement of this fund of fund instead of the statements of the underlying 10 or 12 different funds. And you get exposure to the recommended portfolio from the fund house. And lastly, it's very affordable. So investors can, you can start SIPs from the investor, whether they're investing a few hundred rupees or a few thousand rupees or a few lakh rupees, you can invest in this one fund of fund and get the underlying exposure. And lastly, just to highlight the difference between, for example, the balanced advantage fund and the fund of fund. Balanced advantage fund provides exposure to 2 asset classes, domestic equity and fixed income. The fund of fund provides exposure to 4 asset classes, domestic equity, international equity, fixed income and gold, right? And also you get exposure to the highest conviction ideas of the fund house in the fund of fund along with the sector rotation. So overall, the way I like to position our asset allocator fund of fund, it's like you can think of it as a partnership between the fund house and our distribution partners, where our partners can focus more on the investor management, managing
Right.
their psychology, whereas we focus more on the investment management part of it.
Right. I think the main point which you just mentioned, that you can leave the job of managing the asset allocation to the fund manager and spend that time to acquire the new clients.
Exactly.
That makes a very compelling case for the advisors to recommend this fund to their investors. Now we have already spent more than an hour.
Sure.
I would request you to please share your concluding remarks. And then we can perhaps close the session.
Yeah. So to conclude, I would just like to say that our endeavor in this providing the solution-oriented product is to make life simple for advisors and their clients, right? So instead of having to track markets which have become very volatile, right? And there is no way advisors or investors can be ahead of the curve because things are moving so fast globally as well as in India, right? And as far as as part of a process in this fund of fund, that's what we try to do. Like we try to stay one step ahead of the market and proactively rebalance the asset allocation as well as the funds in each asset class with the objective of delivering a stable risk-adjusted return for the investors. And I'm assuming even advisors have the same objective as far as the clients are concerned. And hence, look at this solution as a partnership, right? Where, like you mentioned, the advisors can increase the focus on acquiring new customers and managing their emotions and leave the job of the actual asset allocation and the fund selection to the fund house.
Yeah. The last question from my side, given the current market scenario, would you recommend the lump sum investment or a SIP or an STP? What would be your preferred mode of investment at this point of time?
So,
including into the asset allocation fund.
Right. So, like I said, our view is that the market will remain range bound over the next 3 to 6 months. And our range was 14,500 to 17,500. The market is already at the higher end of the range. There are still quite a few concerns globally, especially. So there are chances of intermittent corrections happening. And hence our recommendation, though, is to continue with the SIPs. And every time there is a correction, then add some lump sum amount and increase the equity exposure. So that's the best way to do it instead of putting lump sum amounts right now.
So there is a message to our mutual fund distribution partners that as you know that we are running a campaign, a contest by the name Har Ghar SIPs. So if you are doing an SIPs into the asset allocation fund of fund, so we are giving a 200% credit against the SIP into this fund. So do recommend this fund to your set of investors. We believe there is a lot of merit for investors to invest into this fund. And if you have any further queries, please get in touch with your relationship manager, and we will get back to you with the answers. So with this, we end the session. Thank you so much, Vinod sir, for your insights about the markets, about the sectors, about the earnings, and the various factors which are impacting the markets. And also, would like to thank you about the various insightful insights which you have given about the asset allocation part. Definitely, this is going to help our partners to allocate the money into the investors' portfolio. So thank you so much.
Thanks, Birla.
Let's close the session now. Thank you. Thank you.
Take care.